I invested in the stock market consistently for 7 years, and you know what I have to show for it? Not much. Actually, if I'm being completely honest, I would have been better off doing almost anything else with that money. My name is Ben, and 3 years ago, I stopped investing in stocks. And I know what you're thinking. Ben, that's crazy. Everyone knows the stock market returns 10% per year on average. Index funds are the way to build wealth. Warren Buffett says, yeah, I know what Warren Buffett says. But here's the thing. Warren Buffett isn't you, and he's definitely not me. What I'm about to share with you is going to make a lot of people angry. Financial advisors are going to hate this video. The personal finance community is going to call me irresponsible. But I'm going to show you exactly why the stock market, for most average people, is one of the worst places to build real wealth. And more importantly, I'm going to show you what I did instead. Because 3 years after I stopped investing in stocks, I've built more wealth than I did in the previous 7 years combined. So if you've ever felt like you're doing everything right financially but still not getting ahead, make sure you hit that subscribe button because what I'm about to tell you changes everything. Let me take you back to 2015. I was 26 years old, making about $62,000 a year at my marketing job. I was doing what I thought were all the right things financially. I had read all the books, The Intelligent Investor, A Random Walk Down Wall Street. I listened to podcasts. I followed the personal finance subreddit religiously. Everyone was saying the same thing: invest in index funds. Time in the market beats timing the market. Just keep buying and hold for 30 years. So that's exactly what I did. I set up automatic investments. Every month, $800 went straight from my paycheck into my Vanguard account. I bought VTI, the Total Stock Market Index Fund. I never looked at it. I never sold. I was being a good investor. After 1 year, I had put in $9,600. My account was worth $10,100. I had made $500. I felt like a genius. This is easy, I thought. In 30 years, I'm going to be a millionaire. Year 2, I put in another $9,600, but the market had a rough patch. My account went from $19,700 down to $18,200. I lost $1,500 in a week, but I remembered what all the experts said. Don't panic, don't sell, this is just volatility, stay the course. So I did. I kept buying. Year 3, the market recovered. I was back in the green. Year 4, great returns. Year 5, I got a raise, so I increased my contributions to $1,200 per month. By year 7, I had invested a total of $79,200 of my own money. Want to know what my account was worth? $91,000. Now, on paper, that looks like I made $11,800, about a 15% return over 7 years. Not terrible, right? But here's where things get interesting, and this is the part that nobody talks about. One night, I was talking to my friend Marcus. Marcus never invested in the stock market. Everyone in our friend group thought he was making a huge mistake. We would literally lecture him about compound interest. But Marcus did something different with his money. In 2016, the same year I started investing in index funds, Marcus bought a duplex in a decent neighborhood about 30 minutes outside the city. He put down $15,000, he lived in one unit and rented out the other. 7 years later, we're having beers, and he casually mentions that he just refinanced his duplex. The property that he bought for $180,000 is now worth $340,000. He pulled out $80,000 in equity and bought another rental property. I'm sitting there doing the math in my head. He put down $15,000. He now has $160,000 in equity, plus he's been living basically rent-free for 7 years because the rental income covered his mortgage, and he just pulled out $80,000 to buy another property. Meanwhile, I had put in $79,200 and had $91,000, a gain of $11,800. He put in $15,000 and created $160,000 in equity, plus saved roughly $84,000 in rent over 7 years. That's $244,000 in value from a $15,000 investment. And that's when something clicked in my brain. I had been following all the rules. I had been a smart investor. But Marcus, who everyone said was being financially irresponsible, had created 20 times more wealth than me. So I started digging deeper, and what I found genuinely shocked me.
The stock market advice that everyone gives, it's not wrong, but it's designed for a very specific type of person, and that person isn't most of us. Let me break down the 4 massive problems with stock market investing that nobody talks about. Problem number 1. The math only works if you have decades. Every time someone talks about stock market returns, they show you 30-year charts. Look, if you invested in 1990 and held till 2020, you would have made 10% per year. Okay, great, but what if you don't have 30 years? What if you're 35 and want to retire at 50? What if you're 45 and just started investing? What if you need to buy a house in 5 years? The stock market's 10% average return is just that, an average over very long periods. In any given 5-year period, your returns could be 30% or they could be negative 20%. You're essentially gambling that you happen to invest during a good 5-year window. And here's the thing that really bothers me. If you're young and you have 30-plus years, you don't need the stock market. You have something way more valuable. You have time and energy to build real assets, but they convince you to put your money in an account you can't touch for 3 decades instead of using it to build something now. Problem number 2. The real returns are way lower than advertised. Let's talk about that 10% average annual return everyone quotes. First of all, that's before inflation. Real returns are more like 7%. But it gets worse. You're paying fees. Even low-cost index funds have expense ratios. You're paying taxes on dividends every year. You're paying capital gains taxes when you sell. By the time you account for all of this, your real after-tax, after-inflation returns are probably closer to 4 to 5% per year. Now, 4 to 5% isn't nothing, but it's not this magical wealth-building machine everyone pretends it is. You know what else gives you 4 to 5% returns with way less risk? A good rental property with a tenant covering most of your mortgage, or investing in your own skills to increase your earning power by $10,000 per year. Problem number 3. You have zero control. This is the big one for me. When your money is in the stock market, you have absolutely zero control over your returns. None. The Fed raises interest rates, your portfolio drops 20%. There's a pandemic, your portfolio drops 30%. Some bank in another country collapses, your portfolio drops 15%. You can't do anything about it. You just have to sit there and watch. The advice is always don't look at it, stay the course, you're investing for the long term. But that's insane to me. You're taking your hard-earned money and putting it into something where your only strategy is to close your eyes and hope for the best. Compare that to Marcus's duplex. When the property value dropped during the 2020 pandemic, did he panic? No, because his tenant was still paying rent. His mortgage was still being covered. The property was still generating income. The temporary drop in paper value didn't matter because the fundamentals of the investment were still solid. He had control. I didn't. Problem number 4. It doesn't teach you anything. Might be the most important point.
Investing in index funds teaches you absolutely nothing about money, business, or building wealth. You set up automatic investments and forget about it. There's no skill development, no learning, no growth. Meanwhile, every other form of investing teaches you valuable skills. Real estate teaches you about property values, negotiation, tenant management, market cycles. Starting a business teaches you about sales, marketing, operations, profit margins. Investing in yourself through education or skills teaches you how to increase your earning power. The stock market, it teaches you to be passive, to hand your money over to someone else and hope they do a good job with it. That's not building wealth. That's outsourcing your financial future to a system you don't control or understand. So, 3 years ago, I made a decision. I stopped my automatic stock market investments. I didn't sell what I already had. That would have been stupid and triggered massive taxes, but I stopped putting new money in. And I redirected that $1,200 per month into 3 different things. Let me show you exactly what I did and what happened. Investment number 1, my own skills and income. The first thing I did was invest $6,000 in learning copywriting and sales. I took online courses, hired a coach, and spent 6 months getting really good at persuasive writing. Within a year, I had landed 3 freelance clients on the side, making an extra $2,500 per month.
That's $30,000 per year in additional income. Think about that. I spent $6,000 and created $30,000 per year in ongoing income. That's a 500% return in year one. And unlike stocks, this income keeps growing. Year 2, I was making $4,200 per month on the side. Year 3, I quit my job and went full-time, making $9,500 per month. No stock market investment could have done that for me. Investment number 2, a small online business. With the extra income from freelancing, I saved up $8,000 and started a small online course teaching what I had learned about copywriting. I spent 3 months creating the course. The first month I launched it, I made $1,200 in sales. Not amazing, but it proved the concept worked. Over the next year, I refined the marketing, built an email list, and created a simple sales funnel. By month 12, the course was generating $3,800 per month, mostly on autopilot. Total investment, $8,000 and 3 months of work. Annual return, $45,600 per year. That's a 570% return. And this asset I built is something I own. I control the pricing, I control the marketing, I can sell it if I want, I can scale it if I want. Try doing that with your index fund. Investment number 3, real estate, finally. By year 2 of this new strategy, I had saved up $35,000. I used $25,000 as a down payment on a small rental property in an up-and-coming neighborhood. Purchase price? $210,000. I put down $25,000 and financed the rest. Monthly mortgage payment, $1,100. I rent it out for $1,650. After expenses, I clear about $300 per month in cash flow. Not amazing, but that's $3,600 per year in passive income. But here's the real magic. In 2 years, the property has appreciated to $265,000. That's $55,000 in equity from a $25,000 investment in just 2 years, plus the $7,200 in cash flow I've collected. Total return, $62,200 from a $25,000 investment in just 2 years. That's a 248% return in 2 years. The stock market would need to do 124% per year to match that. Good luck with that. The results, 3 years later. Let me show you the total comparison. If I had kept investing $1,200 per month in index funds for 3 years, total invested, $43,200. Estimated value, assuming 8% annual return, $48,900. Net gain, $5,700. What I actually did? Skill investment, $6,000, now generating $114,000 per year in freelance income. Business investment, $8,000, generating $45,600 per year in course income. Real estate investment, $25,000, created $62,200 in value, plus $3,600 per year cash flow. Total invested, $39,000. Total new annual income created, $163,200. Total equity or value created, $62,200. I went from making $62,000 per year at my job to having multiple income streams totaling over $220,000 per year, and I own assets that have real value. The stock market could never have done that for me in 3 years, not in 30 years. Now, before you go sell all your index funds, let me be very clear about something. I'm not saying the stock market is bad for everyone. I'm saying it's bad for most people in certain situations. Here's when stock market investing actually makes sense. Situation 1. You're maxing out other opportunities. If you've already invested in your skills, you're already making great income, you already own income-producing assets, and you have excess cash with nowhere else productive to put it, then yeah, index funds are a fine place for that money. But that should be your last priority, not your first. Situation 2. You're extremely high income, low time. If you're a surgeon making $500,000 per year and you work 70 hours a week, you don't have time to manage rental properties or build a side business. For you, the opportunity cost of your time is too high. Just dump your excess income into index funds and call it a day. But if you're making under $150,000 per year and you have evenings and weekends available, you're leaving so much money on the table by not investing in yourself instead. Situation 3. You're truly investing for 30-plus years. If you're 25 years old, have a stable, high income, and genuinely don't need the money for 3 decades, then yes, index funds in a retirement account make sense for a portion of your portfolio. But even then, I would argue you should only do this with money you've already maxed out your own growth potential with. Situation 4. If your employer matches 401k contributions, take that match. That's free money, a 100% instant return. Even I'm not crazy enough to turn that down. But once you've gotten the match, seriously consider redirecting excess savings elsewhere. The real problem. The issue isn't that the stock market is bad. The issue is that it's sold as the only way to build wealth, as the default, as the thing everyone should do first. And that's just not true. For most people, especially younger people with moderate incomes, investing in yourself, building skills, starting small businesses, or buying real assets will generate far better returns than the stock market ever could. The financial industry doesn't want you to know this because they can't make fees off of you investing in yourself. Charles Schwab doesn't get a cut when you buy a rental property. Vanguard doesn't make money when you start a side business, but you do. You make all the money.
So what should you actually do? Here's my recommended strategy for most people under 45 making less than $150,000 per year. Step 1. Build your foundation, months 1 through 12. Get the 401k match from your employer if available. That's free money. Save up a basic emergency fund of 3 to 6 months of expenses. This goes in a high-yield savings account, not stocks. Then stop. Don't invest another dollar in the stock market yet. Step 2. Invest in income growth, months 1 through 24. Take $3,000 to $10,000 and invest it in learning a high-income skill, copywriting, sales, coding, video editing, consulting, something that can be monetized quickly. Spend 6 to 12 months getting good at it. Then spend the next 6 to 12 months monetizing it through freelancing or a side business. Your goal is to add $1,000 to $3,000 per month in additional income. This is your best investment, period. Step 3. Build assets, year 2 to 5. Once you have that extra income flowing, save aggressively. Your target is $20,000 to $40,000. Use this to either buy a rental property, house hack if possible, buy a small business, invest in a small online business you build, partner with someone on a real estate deal. These are real assets that you control and that produce income or appreciate in value, ideally both. Step 4. Scale and diversify, year 5 plus. Once you have 2 or 3 income-producing assets outside of your job, then you can start putting money into index funds if you want. But at this point, you'll probably find that you have better places to put your money, more business opportunities, more real estate, more investments in things you understand and control. The stock market becomes optional, not essential. The bottom line? I'm not saying never invest in stocks. I'm saying don't make it your primary wealth-building strategy, especially when you're young and have the time and energy to build real assets.
The stock market is a wealth preservation tool for people who've already built wealth. It's not the best wealth creation tool for people starting out. You want to know the real secret that Wall Street doesn't want you to know? The fastest way to build wealth isn't investing in other people's businesses through stocks. It's investing in yourself and building your own assets. Warren Buffett didn't get rich buying index funds. He got rich buying whole businesses and creating value. Jeff Bezos didn't get rich dollar-cost averaging into the S&P 500. He built Amazon. The stock market is where rich people park their excess cash. It's not how they got rich in the first place. So stop acting like a parking lot is going to make you wealthy. Build something, create something, invest in yourself. That's what I did. And in 3 years, I've built more wealth than the previous 7 years of smart investing ever could have given me. If this video changed how you think about investing and building wealth, hit that subscribe button and drop a like. I make videos every day that challenge the conventional wisdom about money and show you what actually works. I'm not here to give you the comfortable advice that everyone else gives. I'm here to tell you the truth, even when it makes people uncomfortable. The truth is, for most of you watching this, the stock market isn't your path to wealth. Your skills are, your time is, your ability to create value is. So stop putting all your money into something you can't control and start investing in things you can. I'm Ben, and I'll see you in the next one.